Happy Saturday, guys. Welcome to episode 5 of Mortgage Talk TV with your host, Dave Orban, NMLS number 832451 of Mutual of Omaha. It is actually official today. We just got our logins, everything like that. So we are now officially Mutual of Omaha Mortgage. So happy Saturday, everyone. We are going to talk about the true cost of owning a home. So this is always the most difficult part of talking to the customer on how much money they have to put down and how much money they expect to put down when buying a home. So there's a lot of misconception out there because there's other costs that go along with buying a home outside of just what is my required down payment. Obviously, down payment is going to be determined by the program that you go into, and also very likely going to determine the program you do go into. If you don't have a certain amount of money, you can't get into certain programs, so that's why you go with others. We'll get into programs and down payments down the road. Obviously, I want this to be a continuing educational episodes as we go along. So a lot to cover, and hopefully pump these things out, like I said, every couple days or so. So let's talk about the true cost of buying a home. The example I'm going to use is for Maryland. I do business in all 50 states, but this is going to be mostly Maryland because that's where most of my business is. But we're going to cover, everything. Every single state has the same kind of payments required to get into a home. So let's just jump into this. So obviously you have your down payment, right? That's going to either be 0% on some loans, 3%, 5%, 10%, 15%, 20%, or whatever you want to put down, that is going to be your down payment, okay? And you're able to choose that, but again, depending on the funds that you have available, it may limit you to what you can put down. So you may only have 3% to put down, or 3.5% to put down, or 5%. It all depends on what money you have in the bank to put down, or what money you can get as a gift from a family member to put down, anything like that. Okay, so that's going to determine one part of your purchase, what money you can bring to put down as your down payment. The other fees that you're going to have that are involved with purchasing a home is the start of your new escrow account. So if you choose to escrow your property taxes and homeowners insurance, and even if you don't, we still have to collect a certain amount because it all depends on what the current seller has paid up to date on their property taxes. Plus, we need to enact a new HOI or homeowners insurance policy for your new home purchase. Homeowners insurance won't even let you start the policy until you pay 12 months up front. So most likely we're going to collect roughly about 14 months of homeowners insurance if you're escrowing to have 2 in reserves. If you're not escrowing, we're just going to pay the upfront 12 months, and that will be included in the cost or the money that you're bringing to close. Okay. As far as property taxes, this is kind of a sliding scale because it all depends on when we purchase the home, when the seller has last paid the property taxes, and how much we need to pay. Okay. So property taxes are always paid in arrears. The easy way to figure this out, we always collect 8 months. Hopefully we're never short on 8 months of property taxes. And when I say we collect, this is my initial estimate to you to give you a determination on how much money you're going to need to close. I always put 8 months. It may be less, it may be a little bit more, but this is determined once title pulls all their title searches, sees when the last property taxes were paid. That will determine how much we need to collect. Okay, so easy answer is 14 months of homeowners insurance, 8 months of property taxes. All right, that will establish your new escrow account moving forward. So there's always enough in reserves when those bills are paid. Your next fees that you're going to have are your title work, which your title work, and we can get into this to a later episode, this protects you as the buyer of the home from something that could have been on the seller, meaning a lien on the seller, something like that maybe title missed, or this is a point for title to find these things to say, hey, this seller has a $50,000 tax lien against them this needs to be paid out of the seller's proceeds before you get into that home, because you don't want to buy that home with that tax lien on that property. That's a really, really vague example. There's so many different things that could be out there, but that's what title work is doing. They're trying to find all those liens, and then you're also buying something called owner's title insurance, which this is your option. I would always recommend it, but you can either buy in or you don't. But what this protects you is if title misses anything and someone comes back to you maybe 2 years after you own the home and say, hey, listen, I had a private mortgage on this property for $20,000. The seller never paid me, but I see you bought the house. You now owe me this $20,000. Again, very vague example or very kind of bad example, but this is something that could happen. And this is why you buy owner's title insurance. Okay, so that's another fee. So you got your start of your escrow account, you got your title work, and then what you have for your state, depending on your state, and I'm just going to use Maryland as an example, you have your recording fees for the state, which are typically a couple $100, maybe $200, $120, something like that. And then you have your transfer taxes. Your transfer taxes can be very expensive. They're a certain percentage of your purchase price. Now, as a first-time home buyer in the state of Maryland, you get a slight discount on these transfer taxes. And transfer tax is always split between you and the seller, but they're still expensive. I mean, we're talking a couple $1,000s. Again, depending on the purchase price, that couple $1,000s goes up and up and up depending on the purchase price. So just because you have the money for the down payment doesn't mean you have all the money to go to closing. Now, there's other ways to get that back, either being in lender credits from your lender, or we get it as seller concessions from the seller. Okay, your program is going to determine how much money we can get back from that seller. So it could either be 6% back from the seller or only 3% back from the seller. If it's a bank-owned property, meaning you're buying a foreclosure from a bank, you're only going to get 3% back. Okay, so there's a lot of different things to take into fact when you say, okay, how much money do you have down? And how much money are you really going to need to get into this home? Because outside of my cost or the lender cost to get into a home, when you purchase a home, you're going to have other costs, being the appraisal. That's going to be an out-of-pocket fee for you, roughly about $400 depending on the home. And that can go up depending on the type of home. But you also have an inspection. That inspection is going to be an out-of-pocket cost that you're going to pay to your inspector that your realtor recommends or that you know. And that could be anywhere from $200 to $800, depending on what needs to be done on that inspection. Or how many times, if you have an inspection, you ask for the seller to correct things. If you need that inspector to come back to make sure they're done, you're paying that inspector again. So, guys, keep in mind when you're looking at homes and you say, okay, I know that I'm going to put 3% down of this certain purchase price. That's how much money I have. You're going to need more money than that. It always works out that you're going to need more money than that. We as a lender and you as the realtor or your realtor will do whatever we can to keep your money as low as possible. That is our ultimate goal. But please have other reserves, because we don't want you buying this house and we never want you to be house poor, okay? So again, we're gonna talk about this. When you give me a call and you wanna get pre-approved, we're gonna go through all of the numbers to say, hey, I know you really like this house. You said you had X amount. You're actually gonna need this. Or what is the plan in between to come up with this extra money? Either we get it from the seller or I give you maybe a higher interest rate to get you something called a lender credit to knock some of your costs down. But your down payment always has to be from you or a gift. Okay, so that is your skin in the game that you have to bring. Again, we'll get into down payments later, everything like that. I hope this helps. Buying a house isn't cheap, so always have money in reserve and know that things come up along the way, that we don't want you using all of your money before you get into that house, because you're going to need new furniture. Things are going to happen. We want you to still have money in reserve after you buy that home. Hope this helps. Again, happy Saturday. Thanks for tuning in. Please like, please share, do whatever you can, and call me if you have any questions. Thanks again. Bye.